Welcome to the Aramir Roundtable. I'm Tom Nunemaker with our guest Bruno Voisin, who's going to be doing the Rhino trade part 2. We didn't have enough time to finish last week, so Bruno's been kind enough to come back this week and finish it off. So thanks for joining us, Bruno.
Thank you.
Before we get started, just our normal disclosure that Aramir Corporation is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We're not making any specific trade recommendations. We don't know your situation and have no way of knowing what level of risk is appropriate for you. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Past performance is not indicative of future results. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that, I will stop sharing my screen so you can share yours, Bruno.
Okay.
Okay, and we're back, Bruno, with the Rhino trade. So take it away with part 2.
Okay, thanks, Tom. I hope, because it was just a week ago, and maybe some of you have watched part 1 at your own convenience. So we're going to start from where we ended. I mean, the presentation last week was actually in 2 parts. I kind of expected or anticipated it would take more than an hour. So let's go right into the trade evolution, the part 2. I already said, well, a Rhino is a Rhino is a Rhino, and in the end, it's a matter of dealing with brokering butterflies and hedging it almost the way you want, as long as you keep your delta flat and a no gamma type of strategy. So here we're going to look at, some probably more complex issues, but and then we're going to look at what is different between my Rhino and the original Rhino from Brian Larson. So again, what is a Rhino? If we go back to the concept, it's really a flat delta type of strategy. It's the Rhino, basically the name comes from the 2 horns, at least for the African Rhino. Very well know that the Asian Rhino has got only one horn. I kind of last week said, well, you can actually throw everything but the kitchen sink as long as you stick to the concept. A very conservative trade, a flat delta. Then at the same time, it can be a little bit overwhelming or confusing, because the Rhino is supposed to be a simple trade, and if you say to the audience, the members of the Rhino class, that you can do about anything, it can be confusing. I understand that. So that's why I suggested that we start with the stricter guidelines, the rules, and then grow into the trade. I also said that the Rhino can be traded on different underlyings. I think it is meant to be traded on index options, and specifically more the Russell and SPX. The question that has come on trading groups and even previous presentations as whether it can be traded on other underlyings. We're going to look at now specifically for the SPX versus RAT. The SPX shows more skew than the Russell. So, but at least it is the same type of skew. If you now trade it on commodities or Forex, the skew dynamics are very different. And I remember last week we had a question about what actually is the skew. And I'm going to look at it briefly later in the presentation. Another thing is, because also I said, I think it was actually the first slide last week, is the trade itself is a representation of its designer's personality, trading style, and of course the way I took over the trade plays a role in the way I'm trading it today. And I'm not saying I was right or wrong, or Brian is right or wrong, but the question is, do we want to trade the hedge? Personally, and maybe because I care for the people who are following me on the alert service, is that if you trade the hedge very actively, you start trading more and more of a call calendar strategy. And if you are a broken wing butterfly type of trader, and if you don't have the experience in trading a very different trade, I think there's a limit to the amount of hedge trading we should get into. Because basically, if you trade the hedge, basically the market goes up and up and you start rolling your call calendar hedge. At some point, you are really trading a call calendar strategy. And you probably keep down below your broken butterfly combo. And actually, it's good to still have it because it becomes a downside hedge for your ATM trade, which is now a call calendar strategy. So I chose, and also, when you are a mentor or coach on an alert service, you don't really know your audience, and you don't know the level of knowledge, the experience. So I chose not to trade the hedge very actively. If I knew, or if I had set a much higher prerequisite that you need to know and have a lot of experience with all sorts of combos, I would say yes, let's go and be more active on the hedge. But I assume that people want to trade more the broken butterfly strategy in more depth and not so much the hedge itself. So it's a personal choice. And the thing I've done also is to incorporate more adjustments and setups from similar strategies. For example, the RTT. The RTT is naturally more forgiving on the upside. We've had a very bullish market. So why not being inspired by other strategies? I mean, there's nothing wrong with that. So as I said, we're going to have a quick look on the skew. The skew, that it was a question that was asked last week. And of course, we all base our modeling, our thinking, or analysis on Black-Scholes. The Black-Scholes is a very old formula. It dates from 1973 at a time where the option chain was very different. The market was very different. And the Black-Scholes, when it was created, looked very much valid. It's only when the crash of 1987 crash happened that the dynamics change all the time. They still change today, but the dynamics changed, and they realized that the volatility, or the implied volatility across the options chain, was not constant. The Black-Scholes assumes there's actually a constant volatility across all option chain. So that's why the Black-Scholes that is still very much used today is technically, theoretically, completely invalid. That's so since the seminal work of Stephen Heston in 1993 on stochastic volatility. So basically, instead of having a constant volatility across the option chain, but also during the passage of time, he started using a function of strike and also time to build into the Black-Scholes model. So, and that's where the actual term volatility surface came about. So it's an aside, and I know I can, again, I said that last week, I can go very, very deep in this field. So I'm just going to go very quickly through this. And if at the end somebody wants to me to show an example, I mean, you can very easily on option view, and I suppose on one as well, just draw, just create a sample butterfly, broken butterfly or balanced butterfly, and you just change the modeling from uniform, I'm talking for option view, to variable or the new variable, and you will see the effect of skew, the effect of a constant volatility or not. So I'm not going to go too long on this one, but I will prepare a presentation maybe later this month or early September on this. So I'm just keeping this because it's going to be recorded, but let's move on. Now, in terms of adjustments, there is something, I mean, all strategies, I mean, I said last week that the Rhino, and as a matter of fact, a lot of brokering butterfly strategies are very resilient on the downside. And you can choose to, if the market really sinks, you choose to roll back your position. There's something that I use more than Brian in terms of handling the Rhino. Of course, I do allow scaling in to flatten delta, I mean, extend the tent, so, and versus Brian that tends to use very strict rules. You place a tranche, 3 broken butterflies or 5 if it's on the Russell, and he says, well, you scale in on the upside. I don't know why, but he usually doesn't scale in on the downside. So he will have more rollback opportunities than I would with my type of Rhino. But let's just look at rolling back. Another thing that Brian does not specify very explicitly is the 3 phases, the 3 stages in the life of the trade. The growth phase, when the trade is young, 56 DTE and above. Midlife or maturity, where the trade is at cruising altitude. And the aging trade. I mean, is it going to reach a profit target? We know more or less where we're going to end up. And so basically at that point, we start peeling off, we start scaling back, and we keep, of course, to the very important concept of flat delta, but we are going to reduce the capital into the trade. So what if the market then falls in a different IV environment and different stages of the trade? If you are very young in a trade, over 56 DT, the market drops, the rollback is a piece of cake. Really, that's not a problem. The risk is very low, and actually you can actually even make money. Your skew, and again, the skew can be different according to the wing size and the underlying, but the skew can actually help you, and you will probably even make money on the rolling back. But if the IV is lower, and if the trade is already is mature or even older, so to say, the risk will be higher. And it's not only a problem of price, it's also a problem in case of a whipsaw. Our indices, what we are trading on, the indices are all mean reverting. So even if the market drops very sharply, it will bounce back. So rolling back may not be such a good idea. Adding a lower combo may probably be a better idea. It will be cheap, but if you keep your upper combo on, I mean, you will have less of a whipsaw issue. So I think this little table is quite useful. Rollover, I mean, rollover is not exactly part of the rules. If the market would really run away like it did, I think in 2013, remember in January, I mean, the market just jumped overnight, just after the festive season. Yes, it can be an issue. And there again, we need to use this kind of table into consideration. And that is something, again, that I believe Brian has never looked into. He says, well, let's keep it simple. You roll back, you roll over. You don't really look at the risk that is built in the trade, because a trade is very resilient in the beginning and is less and less so as the trade grows older. And even more so if the IV environment, like it is at the moment, very, very low. So that's why it's a bit of an aside. Rollover, rolling up your combos is not technically part of the Rhinos or the Rhino guidelines. And as again, I tend to scale in. So we'd probably add capital into a trade rather than closing the downside combos, but you have to be careful. So what is a normal IV level? To me, a normal IV level is when there's historical or statistical volatility is lower than your implied volatility. Implied volatility is a premium. We basically buy, I mean, we sell volatility and we sell time. Time should be on our side, and if volatility, and fortunately, volatility tends to decrease over time. So, and if you look at this kind of option view graph, I mean, we see that, for example, here, even in the what I would say a pretty much adverse environment of a rising market, we still had that kind of edge. The IV was higher than statistical volatility or historical volatility. Since the mini crash in February, we are in a very different volatility environment. IV is lower, and we had a bit of a reprieve in June, but generally, yes, we have since the beginning of the year historical volatility that is lower, higher than implied volatility. So the trade has changed. I mean, we are in low IV, so in a high risk environment in terms of rolling the structures. Our combos are more expensive. And I actually mentioned on this slide that something that was not part of the original Rhino that I have used on a few occasions is that we can actually hedge the Vega by placing some put calendars probably around the shorts of your lower combo, low broken butterfly, to actually hedge Vega. Because if you have a sudden drop like we've had in February, your put calendar will definitely hedge Vega a lot better. A call calendar on the upside is not a hedge on the downside. I mean, we must always, when we place a call calendar on the upside, it hedges the upside. It doesn't hedge the downside at all. Oh, I think oh no, same problem again. Sorry.
No problem. All right.
Okay. So a little recap on delta alerts. The delta alerts on the upside is -5 per broken butterfly inside the tent, -4 outside the tent, and in low IV, it may be actually lower than that. On the downside, 25 is the maximum, regardless of size. And I usually have a pre-warning. I don't, if you remember, that's something that Brian and myself agree on, is that the trade is supposed to do well in between the horns. So if you pass the horn, the lower horn, basically your lowest shorts on your lowest broken butterfly, you have to be careful. Even if your delta is only 5 or 10 or 15, I will tend to adjust delta before the ultimate alert, which is the delta 25. Something I mentioned last week, and I will repeat today, is that yes, it's not exactly the same Rhino in terms of the underlying Russell or SPX. I've seen the updated guidelines from Brian, and he now also agrees to reduce the delta alert for SPX. And even though he doesn't explicitly say that in terms of a volatility environment, I would say it's actually even more valid in a low IV environment. So as I said earlier, there are three phases in the trade. The growth, and sometimes I use, and Tom will like that, I use that, flying a plane, the taking off and rising. So you climb into cruise altitude. That's so from the start, 77, sometimes earlier, DTE, all the way down to 56 or 49 DTs. Let's say 7 to 8 weeks to expiration. That's a time where you start your initial tranche. Your initial tranche, if you use Brian's pretty strict guidelines, you're just going to slap on a first batch of 5 Russell broken butterflies or 3 on the SPX, and that's it. Boom. Don't think too much. If I'm a bit uneasy about the market, I will, and also if, for example, have capital being used on previous cycles, I'll probably just use 2, not 3 on the SPX, or on the Russell, I use 3, not 5. You have to be flexible. And sometimes it's a choice because the market is not easy to read. Or sometimes it's a requirement because you just want to control your capital usage. Then at maturity, you should be at full size, unless you are, again, a little bit nervous about the market, or unless you are tight on capital. But usually maturity, that's a time where the initial resilience of the trade has faded. Now the trade is mature. You're hoping to get at least one profit target, 4, 5, 6%. And you just want to keep your delta flat. And theta is not kicking in that strongly, but you must feel confident into the trade. And then when the trade gets into descent, approach, and landing, so after 28 DTE, if the market is kind to you, you will get into your profit target and exit. But sometimes, especially in low IV environment where you have to use more capital and the trade takes longer to mature and get to profit target, you need to get longer into the trade. So that's actually the moment where the trade is, I would say, the most difficult. But I would say for people who are new to brokering butterfly type of trading, and the Rhino in particular, I would say if you don't get into your profit target, don't fight too hard to get it. If you're part of the alert service, I will of course help you through it. But I would say for people who begin with this type of trade, just let go and move on to the next cycle. As a matter of fact, the trade is easier, but it will also yield a lower return overall if you start before 77 or even before 84 DTE, and if you then decide to, no matter what, close around 35 DTE. It's going to be an easier way to get into this type of trade. You will make less. Theta will, I mean, if you want to make money, you have to take a bit of risk, and theta really kicks in the last month. So it's a trade-off, and that's also a matter of comfortability into the trade. So if we recap on the takeoff phase, depending on the IV environment, we will use scaling to be in full size by 56 DTE. As the conventional wisdom says, a down day is preferable. I entered the October trade on a down day when the SPX was around 2,800. The skew didn't help in low IV environments, so whatever vol pop we got didn't really help. But I mean, I would say in a normal IV environment, yes, let's stick to that rule. You may choose to move your shorts up and down depending on the market situation, but generally the scaling in is the best way to keep your delta flat. If the market really drops, again, the trade is very resilient. So why not just closing and repositioning it? I mean, there's a chance you will, on a very sharp down move, you will, thanks to the skew, you will close your trade for break even or a profit. Sometimes not so, I mean, maybe sometimes a 1%. So let's close it and reposition it. I mean, it's you will get your new batch of broken butterflies at a very cheap price. So in the event of a bounce, your upside risk will be minimal. So usually it's a good thing to do. Just close it and reposition. You're still in the, I mean, it's like a failed takeoff. You just do a round and start again. Cruising altitude, check your Greeks for a flat delta. That's where the discipline of I would say in the first 2 to 3 weeks, I wouldn't say it's as easy as an RTT, but there's not much to do, really. At cruising altitude, you need to keep your target in mind. So that's where the discipline into the trade is the most important. And that's why sometimes people on my class maybe question, like now I've got September, which is mature, and August is done, and October as I wouldn't say has suffered, but I mean it's down maybe $200-300 because of the sudden move up. Am I concerned? No, because I'm going to just it's still the growth phase. I only have 3 broken butterflies into the trade. We are what 70 odd DTE. I will just add into the trade as time goes by, and I'll be at full size by 56 DTE. So the September trade now is my what really occupies my trading day. So check the market outlook, the IV environment, which to me is of concern. The VIX right now is at 1072. It's not very good. And if the market drops, it means that people are underhedged, and VIX could come back with a vengeance. So we have to be careful. As a matter of fact, it's probably a good time to start Vega hedging. So we could probably maybe put a cheap put calendar around the lowest shorts, or maybe buy teenies. Again, that's something that is not part of the guidelines of the rules, but it just makes sense. So we check the skew, especially in low IV. And something I recommend traders to do is to analyze your broken butterflies in terms of what composes it. A PCS, put credit spread, and a PDS, put debit spread. So everything is a trade-off when it comes to trade a broken butterfly, and basically any combo. If you do reverse Harvey, basically you weaken your PDS. So if you are really focused on making your upper expression line look better, yes, that's fine. You may even go delta flat. And like the RTT, I don't go delta positive. But yes, you have to be, you have to also consider, you cash in a little bit, because basically you put another put credit spread into play. But yes, you're also losing protection on the downside. So that's why I always look at my broken butterfly in 2 parts. The PCS, that's where we collect money, the premium, and PDS, what we pay. So of course, if we reduce the PDS side, it will cost us less. But in the end, we also get a lower protection on the downside. Towards the end, theta kicks in. So we just want to, I mean, obviously the best is to be, again, in between the horns, or even better, under the tent of the broken butterfly. We just want to keep the T+0 flat, T+0 and T+N, but we do not project that much. I mean, we are close to landing. So whatever we do, we don't want to add capital to the trade. So if you want to raise your upper expression line, it is a time to use rather a short condor than a straight PCS, because A short condor will be will maintain the capital usage. If you want to release it, I mean, it depends on the strike you're going to choose, but do not add capital this late into the trade. I think that also towards the end of the trade may be a bit more difficult. I chose earlier to show the risk when it, in terms of rolling up or rolling back the butterflies. You get theta, so it's actually good, but at the same time, you can get into high gamma. That's why I always try and also keep gamma as small as possible. And if the market runs away like it has done for too long, probably the best way is to get rid of your upside hedge and just finish the trade in RTT style. I mean, for peace of mind, you probably at that stage you already have a mature trade and you start looking at entering another trade. So towards the end, you don't really want to spend too much time. So either you close it or you try and make it as simple as possible. As an aside, in the Rhino alert service, I have two variants. One is the regular trade, which is closer to the rules, and which I will close, like I've closed the August regular last week, but I still have an August extended, which is more suitable for people who are slightly more experienced with trading. And also in terms of capital usage, I think it's more suitable for people who are on portfolio margin, because you don't want to be too constrained with the planned capital I have set. So the extended variant still uses the maximum 25K per tranche per cycle. And but then I used that $37,500 planned capital in PM. So overall, it's the same. But in terms of Reg T, you may go above the planned capital. So I would say the extended trade is for those who are a little bit more advanced and trade on PM. So differences between my Rhino and Brian's Rhino, and maybe, not maybe, most probably your Rhino will be different as well. So I'm not going to say Brian's Rhino is vastly different. No, we do have the same objective. I think Brian tends to oversimplify the trade. The trade is simple, but I would say, especially when the market evolving the way it has been, we can't just forget about, for example, the IV environment we're in. So I would say I take a lot more things into consideration, which I think is a good thing to learn to become a better trader anyway. And you will take from me, and I very often in discussions on the Slack group say, well, if you are more bullish than I am, do this. If you are more bearish than I am, do that. I mean, in the end, I want to teach everyone to build their own Rhino, not necessarily mine. So that's why I said in the first presentation last week, it can become a more generic type of brokering butterfly trading. And in the end, it's a matter of really fitting your trading style, your personality, and your risk profile. I think the Brian's Rhino is more a take it or leave it type of Rhino, so to say. We do agree on a few things, at least. In particular, yes, the trade will do well in between the horns. There's nothing wrong with that. The alert levels may change slightly, and in the end, your own will change also. But overall, it's the same. As I said earlier, we can also choose to trade the upside hedge more actively. I don't, maybe because it's too time consuming or for any reason that is, but I mean, you may choose to trade the upside hedge more actively than I do. lately, I've used more broken butterflies on the upside because I noticed that cold calendars do not behave too well in low IV. I know that it can actually be confusing because the cold calendar is supposed to be Vega positive, but that's a more advanced topic on, sometimes I call it the call Vega being different from the put Vega, but I'll have when I have a presentation on modeling and skew, I'll explain that in more detail. And also some people may be not comfortable with horizontal spreads at all. So for that reason, I would say, yeah, stay in your comfort zone, use what you think is best for you. And there's nothing wrong with broken butterfly. Of course, they add some negative Vega to the trade. So be more conservative in terms of, be more careful, I would say, in terms of your delta. And definitely with an upside broken butterfly, I would not go delta positive. Now, recently in low IV, I've actually switched off the variable mode or vol surface mode to stick to individual volatilities for to use the TOS jargon, or EIOIO to use the option view word for it. I would say, yes, you add Vega, so be more careful. Go for EIOIO, disable the vol surface, and try and have, always, as always, a flat delta. But be careful, if the Vega, if IV comes back very strongly, the Vega will go against you. So, I mean, I would say, yes, know your stuff. I mean, if you know your Greeks and you know the sensitivity of your trade to the environment, everything will go fine. The differences I noticed is that Brian doesn't really look at market view. Again, the way it's marketed is Rhino. You just enter as mechanically as possible. Entries are on 770T, always the same position size. It may be suitable for a lot of you, but I don't think, I mean, it was not to me. I mean, and, but there's nothing wrong. I mean, another thing, and I don't want to speak badly about Brian, but Brian doesn't really look at planned capital across cycles that much, or even if at all. So yes, I mean, okay, same position size, because you kind of ignore the previous cycles you may have, and that you may not, that you have on at the time. So if you look at one trade, completely ignoring what else you've got in the market, I mean, I think it's a bit of a mistake, and I'm being kind. So for all sorts of reasons I've already mentioned, yes, you have to be a little bit more subtle about your entries and position size at the time of entry. Brian does not propose an RTT mutation into the trade. He would rather trade the upside hedge very actively. Sometimes it's a personal choice, and sometimes it is something I've got into because of my choice to have a wider wing SPX Rhino, which has more skew. So I would say that if I had chosen to have for example, an 80/60 broken butterfly, I may have had a flatter skew, and then I would probably have kept my upside hedges longer. I wouldn't go as far as trading the hedge as actively as Brian does, but I would probably have delayed or not always chosen to mutate the trade in RTT. So it's partly my choice of a wider wing Rhino that explains the RTT mutation. So just want to make it clear. Brian's Rhino does not trade on planned capital. When I took over from him, actually sent me all the back test he had done, and I've seen that often he exceeds even on a single trade, single cycle. And I understand that planned capital is a bit of a benchmark, but at the same time, even John Locke says, well, if need be, you have to be ready to exceed your planned capital. I don't want to. I mean, money doesn't grow on trees, so you have a certain capital to trade, and so I'm very strict on that. So sometimes on a single cycle, he has gone above planned capital, and he doesn't really look across the 2 or 3 trades he may have on at any point in time. So that I strongly disagree with. And the fact that he wants to trade that does not look at the vol regime we're in, to me, if you ignore something, you basically open the door for a problem later on. So you have to be careful. So I would disagree with that. So what I don't agree, because we all have market bias. So I don't, if the market is bullish, I know I've played around with another variation of the Rhino, which I've called a dancing Rhino, which would be definitely more leaning towards the market bias. But I'm not trading it on the class, but that's something that could be, I mean, again, it shows that this type of butterfly strategy is quite versatile. You can actually make it the way you want. You can choose, if you have a strong bullish flag, to change your delta alerts completely. And I will come to that. I've discussed that with some of the members of the class, but not to confuse people, I'm not going to do like John Locke has done with his X4. It's almost funny because John Locke has X4 version 22, 23, 394, 796. Basically, he's got. I'm kidding a little, but you can have different strategies for different market environment. But that's, I think he's going a bit too far down that road. I'm saying that yes, we have a market bias. We have a strategy, and the strategy is based on concepts. Then the way you turn those concepts into your own trading style is up to you. I wouldn't go as far as having too many variations. As I said, I've got a dancing Rhino up my sleeve, which would be a lot more leaning towards the market direction, but I'm not trading it at the moment. I've put at the bottom of the slide that many of you must be familiar with my ongoing ranting against backtests. It's a statistical fact. I mean, backtests they can be a good way to build self-confidence into a trade, but statistically, you need 30 to 40 samples per degree of freedom. I'm just using the usual rule of thumb statisticians have. So just imagine if you have a strategy with a number of branches in your decision tree, just imagine the number of degrees of freedom you have. So I would say if you use backtest, yes, but preferably for a weekly trade and preferably a no-touch type of trade. If it's a monthly trade and you have degrees of freedom, you will have to go back 10 years or more. 10 years would only be 120 samples. So it would not even cover many degrees of freedom. So I would say take backtests with a pinch of salt. So the trade is very simple, but to me, it's not an excuse not to think and not to do your homework and not to stay within your planned capital. That's something I'm very strict about. And I said you have to be disciplined. I think being part of the class, you see that every day I send the game plan, the morning notes. I check what the futures market looks like, and maybe the Dow Jones, because I know that the overall, the SPX is very correlated to the Dow Jones. So, you know, you get into a routine. Being part of a class, you get into a routine. And I think it's very important. As I said earlier, yes, I mean, self-criticism is actually very important, and I take blame. For example, the March trade, I didn't do well. I don't know what went through my mind, but I should have put those put candles on, and I don't know, for any reason, I didn't, and that would have saved the trade, or at least have reduced. It was a down month, and I would have done a lot better. So sometimes I also make mistakes. You must learn from your mistakes. So was overall in the last 2 years, the wider wing a good choice? Who would have said the market would have gone up so much? A wider wing and a larger skew give the Rhino better downside protection. So it's more work, as I said last week. More skew means more work on the upside. So in hindsight, yes, I should have gone for the 80-60 Rhino, or even maybe the 75/50 Rhino. And as I said, for people who want to start on the Rhino, the Russell Rhino is probably a simpler trade. The Russell, regardless of size, exhibits less skew than the SPX. And in a way, that's the largest skew, 100/75 Rhino, has motivated the occasional RTT mutation, or sometimes a mix. When the market is very bullish, for example, something I've done actually a few days ago on the October trade, I scaled in with an RTT type broken butterfly. Why? Because it came with a credit, and it doesn't add, so credit means it doesn't add to the potential loss on the upside. So for all sorts of reasons, scaling in can actually be a typical Rhino type of brokering butterfly, or sometimes the scale in will be the opportunity to mix it with an RTT type brokering butterfly. You learn to deal with a brokering butterfly no matter what type it is. That's the beauty of it, is that if you want to keep your delta flat, your upside risk at minimal, you choose what is part of your tool set, and your tool set can be a typical brokering butterfly, or it can be a Rhino type of brokering butterfly, or it can be an RTT type of brokering butterfly. Another self-criticism: should I have traded the upside edge more actively? Maybe. There's no answer to that, and again, it will be a personal question to ask oneself. Is it going to be, this generic broken butterfly trading, is it going to deter beginners? I hopefully think it won't. You can start with the Russell, you can start with stricter guidelines, and you can start growing into this type of trading, and then extend your tool set as experience grows. I would say the barrier to entry is very minimal. And on the other hand, the trade is very, very, very ambitious. We can actually do a lot more. And that's why I said, and that this type of strategy could become almost like a generic trading for the broken butterfly family. And lastly, are there more things I may introduce? Yes, I may introduce more layering. So basically transferring capital from cycle to cycle. And something I am considering is adding more bear hedges for the more conservative traders. I see my time is almost up. So let's go to the summary. More variations on both sides, user market view, a bit more maintenance than a quasi-mechanical trade, so to say, would be. I would say be realistic and use your common sense. That's quite important. Something that is my personality, my trading style, is that you must always keep learning. If you rest on your laurels, if you think, well, that's an easy trade, I don't have to think, you won't get far with trading. So I would say keep trading and keep learning. I know I'm a terrible speaker and a terrible mentor, but let's recap. I send a daily plan every morning, often an update at the open. My alerts are always in 3 stages: plan, order, and fill. So members of the class are never really surprised. I mean, they know what the market environment is about, and it's not like I send an order and they have to rush and place it and get a fill. No. But by receiving a plan, they have time to prepare. And then when I send an order, I mean, I think everything is done in the coolest possible way. Also, we discuss a lot of things on the Rhino Slack group. Some people say, well, is that really what you're doing? And I say, yes. Or they double check the strikes and I say yes or no. Sometimes I make a mistake. I have to confess that there's not too much sugar coating, and I mean, I also it goes both ways. I give, I share my expertise, but I also want a feedback, and I want people to do their homework. I mean, otherwise, there's no way people will learn. Don't expect from me a textbook recipe. I would not agree with that. That's not me. So I just want to say thank you. We almost an hour, so I think the timing this time is okay.
Yeah, it's fine.
So for to finish up, I chose to show some quotes from Bertrand Russell. The whole problem with the world is that fools and fanatics are so certain of themselves, but wiser people are so full of doubts. Yes, you must keep having doubts. You must keep, I mean, that's the way you progress. If you are sure, I mean, I know I'm right, the market's going to go up, I'm going to just go and buy calls, and that's where you get into trouble. So I would say, yes, learn the Greeks, learn how your beast, your combo, complicated, complex, or simple, will react to different market environments. And it's the only way to learn, and the only way not to be surprised when the market doesn't go your way. And that being said, I know that we rely on platforms, and that's something that I won't get into right now, because otherwise it will take another hour, part 3 and part 4 and part 5. I agree that we rely on platforms that are inherently wrong. Calculations are often wrong, or they're just as good as, okay. So, and I know a lot of traders tend to mentally compensate for the flaws of the software. But that's why, I mean, I hope to, at some point, to have a better model. But yes, you must have doubts. You must also question the quality of your modeling. You must sometimes add some vague exposure just to make sure that, okay, if market goes pretty ugly, I just don't want to lose too much. So again, I hope you understand the gist of it, the way I think, and I hope you agree with me, at least largely. Thank you very much.
Oh, Bruno, before you go, there's a couple of questions. I don't know if you saw. Did you?
Oh no,
see
no,
the
I don't see those. I'm sorry.
Okay, George asked, why don't we trade the NQ?
I have never tried that, but I would. Again, I will definitely look at the skew and how it reacts. I would say it should work. I've never done it. I've got enough work with different, I mean, the Russell and the SPX in different wing sizes. The NQ should work. It can, as I said last week, it can also be traded on the ES. The SP futures, it's no problem. NQ, I would need to study it a bit more in depth before I move on to. I would say yes, it will work. Yeah.
Okay, great. And then Lewis asks, is it fair to say that if the underlying has a strong move to the upside, one will be forced to trade the hedge?
Oh, sorry, can you repeat?
Oh, he said, if the underlying has a strong move to the upside, will you be forced to trade the hedge?
The best position is to be between the horns. So basically, if you start rolling your calendars, yes, you are trading the hedge. If your calendars behave okay in normal live environment, you will probably cash in So make profit on the hedge and start moving it up. Yes, that can work. Because in low IV, the coal calendars have not done so well, I've chosen most of the time to then turn the trade into RTT. But yeah, I mean, there's nothing wrong with trading the hedge if you do it properly. Yeah.
Okay, and that's it for the questions.
Thank you.
All right, Bruno.
This time I've done it within an hour.
Yeah, perfectly done. So nice job, and I hope people take advantage of the Rhino. It's a great trade, and Bruno, you do a great job with it. So thanks again.
I hope I'm not too intellectual, too mathematical, but I know that my focus now is to do modeling, and I will schedule a few presentations in September. So I would say don't be afraid if my talk sounds a bit too complicated. The trade is still pretty much simple, and there's a lot of hand holding in the class. I mean, it's a good thing that we can interact and we can really, I mean, I know some people are more bearish than I am, some are more bullish. I mean, we can adapt the trade. I do actually follow individual trades. So some people, sometimes they miss an adjustment, or, I mean, the good thing is that, yes, I mean, of course, time is limited, and there's a limit to what I can do within the class. But all I'm saying is that I'm helping people to make the Rhino their own. That's really my motto.
Sounds great. All right, Bruno. Well, you have a good one, and thanks again. Appreciate it.
Thanks, Tom, and thanks to everybody.
All right, we'll see you.
Okay, cheers for now.